Four don'ts for beginner investors in the stock market. Many investors, especially beginners, lose money in the stock market for avoidable reasons. My name is Dr. Sana, and in this video, I'm going to share with you four key things not to do as far as investing in the stock market is concerned, so that you'll be able to know exactly what to avoid as an investor and to also help you take more informed decisions in the stock market. The first thing not to do is that do not treat the stock market as though it is a gamble. Many investors, especially beginners, enter the stock market with the aim of making overnight profits. They enter the stock market to make quick profits and exit the market. But over the years, it has been proven not to be so. So you see a lot of beginner investors losing money in the market. And this is simple. The stock market is made up of real businesses, real companies. And what do? They come to the market to raise funds to invest in their businesses. They come to the market to raise funds to expand their businesses. And you and I know that businesses take time to make profit. It takes time for them to expand. So if businesses take time to expand, grow, and make profit, then it reason to understand that we too should be patient in the market. We too should not be hurried to make quick money and leave the market. So if the idea is to grow your money long term, you have a long term investment and financial goal, then the stock market could be beneficial to you. But if the idea is to make quick money in the market and exit with a lot of money, then the stock market could be disappointing to you. It can disappoint you one time. So one don't, especially for beginners in the stock market, is that do not see it as a gamble, as a way to make quick money and exit. Plan long term, have long term financial goals, and in that way, you will be able to invest over time and allow your investment to grow, allow the businesses and the companies you have bought their shares to also make profit and share those profits as dividends to you, and also allow the share prices to increase so that in the future you can sell the shares that you bought and make profits. The second thing not to do in the stock market is that do not invest all your money in a single company. Do not use all your money to buy shares of a particular company. This is because companies can collapse. The fact that a particular company is doing well today does not mean that it will do well forever. So companies over time can face challenges. And in fact, there were companies listed in the Ghana Stock Exchange some years ago, let's say 10 years, 20 years ago, but they are no more in the market. They've been delisted for various reasons. So if an investor had used all his or her money in buying shares of those collapsed companies, it means that the investor would have lost everything. So diversification in the stock market is very, very important. And you do not have to hold shares of 5, 10 companies as a way to diversify your funds, especially for beginners. You can consider investing in mutual funds, index funds. Those funds are diversified funds, and once you hold one financial product, it it signifies that, or it represents diversification. Mutual funds, index funds are usually okay for beginner investors, and I'll be talking about them in my subsequent videos. So the second thing not to do in the stock market is that do not put all your money into buying shares of a single company, because it can be very, very dangerous. If once the company collapses, you lose everything, and you do not want to lose all your investments in the market. Another thing not to do in the stock market is that do not be so much emotionally attached to the market. Many investors, especially beginners, always find it difficult to stand and see their investment go down, especially in the short run. So usually what they do is that they want to salvage the little that is left. So they end up withdrawing their funds at a price lower than how much they bought the stock. So, and that is a loss. So what we should know is that the stock market is very volatile. So it can go up easily. It can also come down easily. So once you know that, you'll be able to define your financial goals to meet such volatility, so that you will know that, just as I mentioned in the first point, that the stock market is not necessarily a place where you can easily make money and exit. Having that knowledge will help you to manage how you react to short-term volatility in the market. It will also help you to even take advantage of the short-term volatility, such that if you bought a company's stocks for 10 cedis per share, and you realize that now the share price goes for 8 cedis, as a long-term investor, you can take advantage to even buy more. So in that way, you are not so much emotionally, your decisions in the market is not emotionally driven, but it is based on your knowledge about what the stock market is all about. And I'll give you one example. We all witnessed the domestic debt exchange that the government of Ghana started enrolling or rolling out in 2022. In fact, most investors, retail investors who uh, held mutual funds that also invested in government of Ghana bonds, saw a reduction in their principal for not less than 30%. And a lot of people got panicked and they started withdrawing their money. And I had this friend who told me that he had requested to withdraw his money from a mutual fund company he was investing his money in. So the suggestion I gave to him was that he should consider allowing it to see whether the market will bounce back. And I don't know whether he actually did so. And if he did so today, you'll be happy that he did so, because the market has recovered. And in fact, it's even doing far above what it lost due to the domestic debt exchange. So that should tell us that short-term volatility should be managed well. It should be managed with knowledge, not emotions, so that you do not panic emotionally and you start withdrawing your money in the short run. Another way to look at it is the fact that sometimes investors, especially new investors, they see a particular company doing well, and that kind of fear of missing out, which is well known in finance, creeps in. So they are afraid that if they don't take the advantage, they will miss out in the market. So they sink in a lot of their investment into buying shares of that particular company. And usually it is not out of knowledge, it is out of the fact that you are afraid that you will lose if you do not act quickly. And that emotional way of making financial decisions are not usually well, or are not usually okay. So it is important not to be so much emotionally attached to the stock market, because it can make you take certain decisions that are not optimal. The last thing I want to mention is that do not start investing without doing your own due diligence about the company or the financial products that you want to invest in. This is very, very important. Most of the times, beginner investors especially hear about investment products from, let's say, friends. They read about them online and they start to buy these products. This is not a good idea, and this is not always the best way to start your investment. You should start with knowledge. You do not have to be technically knowledgeable about the finances of the company before you can um, make certain key research. Some of the key research questions you should ask about the company are these: whether the company is registered or whether it is well regulated in the market, and the kind of sector the company is in. Is it the financial sector? Is it the energy sector? This is very important because probably you might have already been holding shares of companies that are in some of these sectors. So let's say if you are investing in a company that is in the banking sector and you hear about a particular company that is also doing well and you do not do your due diligence to check the kind of sector it is and you start to invest, that means that you may be just simply duplicating, and any risk that is associated with the financial sector will affect your investment in both companies, and this is usually not good. So it is always very important to do your own due diligence about the company and the financial products that you want to invest in. And as I mentioned, some of the things you should ask yourself is whether the company is well regulated, the kind of sector it is investing in, and the kind of fees that it is even charging. Because sometimes beginners they start to invest and later on they complain that, oh, the company is charging a lot of fees. This is because they didn't even check in the first place. So making your research about the company you want to invest will help you take care of some of these problems that may arise. So it is always very important to learn. It is important to do your research. In fact, financial education in general is very, very important for everyone. And you do not have to have money ready before you start to learn. Begin to learn about the stock market, begin to learn about the financial market, and prepare yourself before you take that step to start investing. If you find this video educative, don't forget to like, share, and subscribe to this channel for more. However, this is not meant to be a financial advice. It is meant to educate and to inform. If you need any financial advice, do not hesitate to reach out to a financial advisor. Thank you, and I'll see you in my next video.